Hey, this is Tim from EminiMind, and I'm doing another Monday market analysis video here. It's Monday, October 3rd, and we're kicking off the week starting with the ES, looking at the weekly chart actually. Um, I'll put on the fib retracements, and you can see the low to high from COVID lows to all-time highs. That's that 3493. We're just calling it 3500 just because it's a big round number, and that's more than likely where we're going to be headed. And it's more than likely that we won't just stop there and bounce. The negative 23 from the short that we're currently in is like a 33.63, somewhere in that area. And so I'm not necessarily super eager to just buy up that 50% on the daily chart. I would rather wait for a swing high to break on the daily chart and then get in on a pullback for like a longer term swing, to maybe add to some longer term positions, that kind of thing. But this is what the weekly chart looks like. You can see today's candle is inside of last week, just the first day of the week, and the target was just down here below us. So we'll see what the week brings. Definitely a little bit change in sentiment and feeling so far today. If we look at the daily chart, we are at the negative 61.8 on the smaller 50% retracement. That's kind of within the larger short, and so the expectation here is that we would get some sort of a bounce. Now, if we draw up the next traditional retracement, something like this, it's going to be worth paying attention to and look at, maybe buying some puts around this 38.66 area. I use the SPY to buy my puts. That kind of lines up with the swing low back here. And so if we were to come up to this 50% and get kind of a bullish close, that's where I would look at buying the puts. If you draw the full halfway back, you're talking, all the way up at like a 4,000 in that area. So we'll see how the week goes, but it wouldn't surprise me at this point if we get a bounce to this 38.66. Your biggest up days always come in the context of a downtrend, so keep that in mind. The other thing I wanted to point out before we get too far in here is that the Heikin Ashi's, that candlestick kind of variation that I use on the 512 tick chart. I don't use it. I only use it on the 512 tick chart, but it can be useful to glance at on a daily chart. I just don't keep it on my chart permanently. So what I mean by that is here's our traditional, candlesticks, open, high, low, close. The shaded body means a bearish bar. The open body means a bullish bar. And if we put that Heikin Ashi study on here, or candle variation, look at what we have. It smooths the chart quite a bit more than the traditional candles. And notice we've got our first green day, our first green closing day on the Heikin Ashi. The way that Heikin Ashi works is that instead of taking the open price, it just starts from the midpoint of the prior candle. So you'll notice each candle here, the next day, once it starts, that starting point is from the midpoint of the prior day, the midpoint of the prior candle, as opposed to just the opening price. So it sort of ends up stringing along a longer color trend. And so if you use the Heikin Ashi on something like a daily chart, you can stay in, it can help you stay in these trends a little longer, especially if you wait for the day to close. Because like back here on the 21st, if I go to the traditional candle, look at the 19th, how we broke above the prior candle's high, and then here's the 21st where we gapped up and started moving higher. I know it doesn't look like this, look bullish on this candle because we closed super bearish, but at the early point in the day we had gapped up, moved higher, and things were looking more bullish because we had the hammer the day before. But when we put on the Heikin Ashi, it does confirm that, okay, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 days. The last 2 weeks have all been, sustained downtrend. Whereas if we go back to that traditional candlestick, there's a little bit more fake out that you see, especially in these 4 days, where it looks more sideways. You have a bullish close that's above the high of the prior day. That's kind of a bullish signal. So if you are swing trading or holding some trades overnight, or maybe intraday, you just only want to trade in the general daily trending direction, the Heikin Ashi can be helpful for that. I mean, you could even go so far as to, you know, sell on the first close of the red candle and then buy back the first close of the green candle. You know, you do get some instances here where you get like a red bar, green bar, red bar, green bar. But by and large, you know, the bigger trends, even if you're going to swing trade and, you know, go long above the high of that low bar and whatnot, you can still catch some swings. You know, you get one red bar, even if you went short, you know, put a stop above the high, and then you can flip, and then you can go long, and that winning trade easily outdoes, you know, a little one candle daily stop or fake out or whatnot. And then you get these stretches here where it's just down, 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 down. So now that we have that first green candle, if we can close a second day green, then you know, definitely more than likely make it up to this 50% short. If it's just, you know, if tomorrow we just sell off and break today's low, then that 50% daily long should be pretty close or near term, and, you know, maybe even hit it this week. Another couple things I wanted to talk about. So yeah, keep an eye on the puts, um, and it's important to keep, you know, keep the larger picture in mind. But then as you zoom in intraday, you know, the benefits of day trading are we can go, you know, long and short. And so one of the things I think gets a lot of traders tripped up is that they're constantly sucked into news, and it's, you know, why is this happening? Why is the market going up? Why is the market going down? And if instead you don't focus on that and just focus on, you know, where can I find a setup? What is my setup? And then looking for those specific setups and trying to be as consistent with your entry, your trade management, and your exit as you can. Because repeating that multiple times throughout the day and throughout the week is what's going to build the consistency over time. If you spend your time, you know, focusing on the media and the news and the actual reason behind why this is happening, you know, then, you know, you're more of a fundamentals trader, and you're talking longer term swings that are going to have an impact over, you know, months versus the technicals that are impacting, you know, right here and now in the moment. The other thing that I've had questions on lately is, you know, oh, should I be buying? Should I be buying the move down here? Is today a good day to buy? The safest bet is to wait for when we break a swing high and then buy the pullback. So like I said, if we come down to the 50%, right now the swing high is all the way up here. And if we, let's say we bounce a couple days and then we roll over and we touch the 50%, and then we get a bounce and break that swing high, then I'd be look at buying a pullback at the next 50%. But when you think about, you know, okay, I've got a long position. Like for me, it's VUG is my longer term position, just a, you know, Vanguard growth fund. Pretty boring. But when you think about, you know, the position that you already have and how many shares you're going to add to it, it really doesn't make that much impact when you're talking about, okay, I've got, you know, a couple thousand shares right now, and if I'm going to buy, you know, 5 shares or 10 shares at a time, that price really doesn't matter too much. So, you know, if you bought, you know, some up at, let's say, the highs, the start of the year, you bought the high, and then you know, now we come down to 50%, and you buy this 50%. You know, those 5, 10, 20 shares really don't have that much impact on the overall, you know, average price. But when you get into, you know, these bigger sell-offs, you know, the market sells off 20%, 30%, we're in a bear market, that kind of thing, and you're thinking about, okay, I want to throw, you know, another couple, or, you know, I want to throw 50,000 or 100,000, or, you know, buy hundreds of shares, so we're talking a bigger percentage of the overall shares that you have. Now it does become more beneficial to be, you know, waiting for that swing high to break so that you can be buying on the start of a uptrend. Yeah, you can be collecting your dividends and reinvesting those dividends and that kind of thing. But the opportunity cost, as let's say we go into these next couple of years, there's more volatility. Let's say the market just kind of roughly goes sideways over the next couple of years. Um, Tying up an extra 50 or 100 or $250,000 into your longer term retirement might not be the best opportunity right at this moment. Yeah, you might miss out on some dividends, but you could use that money for other purposes for the next, let's say, 2 years. And then if we get a bigger swing high break and we start to violate some of the bigger downtrends and then you get in, now you're putting that money to work, and it's really, you know, working a lot more in your favor a lot quicker. So I'm not a fan of trying to sell out my whole long-term portfolio and then buy it back lower and then sell it out and then buy it back. Because if you go back to COVID, a lot of people did sell out their portfolio at down at the lows of COVID, and they really didn't get back in, and so they didn't get any of the growth in the last couple of years. So what I like to do is buy the puts, and that's why I'm saying watch for that move up to the 50% short, because that's a good way to hedge your longer term position that you already have. You can keep collecting the dividends and then make money on the move down with the puts. Then you can take that cash and either reinvest it or pull it out, put it in other things. So that's just kind of the bigger picture stuff that I end up doing more of when the market is selling off like this, as well as the day trading. But when the market is on a tear higher, I'm less concerned about doing a major uh, making major changes other than taking some profits off the top. So um, just seemed like I was getting more questions in the last couple of weeks about like longer term stuff, so I wanted to throw that in the video this week. Tomorrow I'll be doing a live trading session. EminiMind.com/VIP is where you can get the link for that, and we'll see what ends up happening throughout this week. If we can continue this move up, there's probably going to be some really good strong trends off the open, and if that's the case, looking at the breadth and advanced decline line can be really helpful. We had a strong breadth and advanced decline line reading today, and we rallied right into the close. So if tomorrow opens up the same way, and especially tomorrow, um, if we gap up, today we did gap up and we moved higher, but tomorrow since we're near today's high, tomorrow if we gap up and we are above today's high on the regular trading hours, that could really send us higher in another, Dow 5, 6, 700 point up move, and we still have a ways to go before making it to that 50% short. So taking advantage of those, intraday uptrends, but keeping the bigger picture in mind and knowing that, okay, when we get up to this level, likely going to look for a short. So if you have questions, you can drop them in the comments below. I hope everyone has a great week of trading, and I will talk to you all soon.